The largest one-day drop in the S&P 500 occurred back in October of 1987 when the index fell by more than 20% in a single day. We are nowhere near that currently, but with the market down 3.5% since open, it is a little scary. So I thought it would be a great time to revisit bear market, bull market, and how you should approach your investing during these times of uncertainty and downturn. Markets go up, markets go down, but your future depends on what you do when things look rough. Just a reminder, a bear market is when the stock market falls 20% or more from its recent high. It's caused by economic concerns like inflation, interest rates, a global pandemic, and of course, concerns over tariffs or trade wars. Investors get nervous, they start selling, and stock prices take a hit. On the flip side, a bull market is when the market rises by 20% or more from its recent lows. As of 9 a.m. on Wednesday, April 3rd, the market has crossed into what we call correction territory, where it is nearly 11% below the recent highs we had in February. So while we are not technically in a bear market yet, I thought it would be a great time to revisit the top 4 things 401k investors should remember during a bear market. Number 1, you are a buyer, not a seller. When the market drops, your 401k contributions are buying stocks at a discount. It's like your favorite store running a clearance sale, except this sale can build your wealth over time. Let's say your 401k buys shares of a fund every payday. If prices are high, you get fewer shares. If prices are low, you get more shares for the same dollar amount. When the market rebounds, as it always has, you'll have more shares that are worth more. Number 2, the biggest up days happen during the worst down markets. Here's a wild stat. 42% of the S&P 500's biggest daily gains happened during bear markets when everything felt awful. Another 36% of those gains happened in the first 2 months of recovery. I want you to take a look at this chart, if you can see it. These are the 10 best days in the S&P 500 since 2003. Notice the day: October 2008, March of 2020, November of 2008. What does this mean? It means the best days in the stock market tend to happen when it feels the worst to be invested. Those days are impossible to predict, and they usually happen right after a steep decline. If you panic and sell, you're locking in the losses and likely missing out on the rebound. Stay in your seat. Number 3, your 401k is autopiloted for a reason. Your 401k is built to handle market swings without you having to be a Wall Street genius. Not all of you, but many of you are invested in a target date fund. This is doing a few things for you. 1, the manager of your fund is automatically rebalancing periodically, which naturally allows them to buy low and sell high, which is ultimately the goal of investing. They are on a glide path that is getting naturally more conservative the closer you get to your target year. And finally, they are naturally diversified. I mentioned that the S&P 500 was down maybe 3.5% today. And that's the stock market index that you typically see talked about on the news. But your target date fund has exposure to many other asset classes like bonds and international equities. The MSCI EAFE, as of yesterday, it's a common index we use to track international equities. It was up 8% year to date. As of yesterday, the U.S. aggregate bond index was up almost 3% year to date. These diversifying asset classes are helping ease the pain of the U.S. stock market correction. Trust the process. Your 401k is doing its job even when the markets look ugly. If you're not in a target date fund, now may be the time to evaluate your risk. But like I said, most 401k investors are defaulted into one of these target date funds. And finally, number 4, history is on your side. Every bear market has ended eventually. So let's end on some good news. Since 1928, we've had 27 bear markets. Every single one was followed by a bull market. On average, bear markets drop 36%, but bull markets gain 114%. The average bear market lasts 9.6 months, but the average bull market lasts 2.7 years. That's right. Bull markets last longer and recover more than what was lost. So, if history has taught us anything, it's that staying the course has always paid off. Look, I get it. Watching your 401k balance drop is not fun. But when it comes to retirement investing, what matters isn't today. It's 10, 20, or 30 years from now. Stay the course, keep contributing, and remember, you're investing for the long game. That's it. This is Jeannie, the 401k lady.